Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets and what we're looking at in some of our portfolios here. As always, please don't use these videos for trading purposes. They are for education only. I always start here with a weekly chart of the S&P 500, and this gives us about the last 5 years or so of trading in the markets. And well, it seems it's almost 4 years ago now that the COVID sell-off came here on the left side, and then all the money flowed into the markets, and a big boost through 21 as the Federal Reserve pumped money in, and the federal government as well. Then, as inflation started to take off and interest rates were raised to offset that, we had a nice bear market here in 22. And then 23, even though there's so many people calling for recession and another bear market, that sort of thing, it just didn't materialize. We seem to have broken the trend and gone higher. Certainly had through the summer there a bit of a sell-off, but that's reversed itself and is now we're just knocking on the door of 2023 highs here, as you can see, and really only just a couple hundred points away from an all-time high on the stock market here, which is really surprising. I think a lot of the pundits out there, but as we pointed out, as we broke the trend line and went higher, that's what the market's telling us to do. And so, as of right now, the long-term trend you can see here highlighted is higher. We could go down here into a little more detail on a daily chart. This gives us the last 2 years trading, and you can see that certainly do 22. We had really choppy action through the bear market with all the little bear market rallies in there that were very steep. But now it seems to have settled down a little bit. It's a little more trend following as 23 started out with a little rally and then a retest, and now through the early part of the year, nice rally that came up there, got a little ahead of itself. Here through the summer, just started moving into a downtrend, and as we pointed out in the last video, that seemed to be breaking now, and might be time to put risk on. And certainly that is what ended up happening. The market has come into a nice uptrend, so now we have our weekly trend and our daily trend are both up. And for that reason, we definitely were more invested as that broke and put us into a uptrend mode. We come here and look at a little more detail. You can see it. This is a 2-hour chart, and it gives us generally about the last 6 months trading. You can see that was the downtrend that was happening through the summer and the fall. And then broke, and now there's not even a trend to put onto it. It's just been literally straight up, and actually it's been straight up here since the end of October. As you can see, we went from 4,100 to 45.83. I mean, you're talking 10% there. Big rally going on. So that's what the market's telling us. It's certainly pretty far from what a lot of the pundits had said, but we here just follow the markets and what they're telling us, and what they're telling us is we're rallying for whatever the reason that is. If we look here at some of the internal measures in the market, slide below here is the percentage of the S&P 500 that's in an uptrend. And certainly by the end of October, we were down about 23%. And right now it's up to 70%, which is a little shy of what you might see during really hard rallies, but that's pretty solid. It's telling you more than 2/3 of the market is in an uptrend at this point. And we had highlighted that last time when we were doing our video that, hey, we were coming to the top of that trend, but a lot of the internal measures were starting to look higher. And for that reason, we were going risk on with everything. The next line down here is the advanced decline line on the New York Stock Exchange. And as you can see, that was breaking trend around the beginning of November as well. And it's just been saying, hey, we're going higher here. So both of these measures are quite bullish or in good shape. The bottom one here is the VIX, the volatility index, and that is down, sitting at 12% or 12, and that's really a number that you would want to see during a rally. So while yes, this may not be the time you want to jump aboard this rally at this point, as I pointed out, it could come up 10% in basically a month. It is telling us that everything underneath the market is strong. The breadth measures are all there. So I certainly don't want to be fighting that trend. A main reason for that happening here, this is the interest rate on the 10-year Treasury, the U.S. 10-year Treasury. And this is giving us about a 10-year look at it. So we want to take a long look at it. And here during COVID and then the year before, the interest rates fell so far. I mean, we were down to basically a 0.5% here on the 10-year Treasury. Well, as inflation started to take off, interest rates started going higher. The Federal Reserve started tightening, increasing interest rates, and that led to the sell-off here. That this is the interest rate going higher, and that led to a lower stock market for 22. Well, we started 23 in the same manner with interest rates heading higher, went up to about 5% on the 10-year. But as you notice here, in the last several weeks, the interest rates have been moving quite a bit lower, down to almost 4% from 5. And what has been the net effect of that? That's this right here as it's moving higher. So we are seeing that the interest rates falling is having a bullish effect on the markets. We go to economic indicators here, the trading economics. You look here, the last GDP growth rate and annual growth rate on GDP. These are both much higher than they had been before. So it's looking stronger than maybe people had first thought. This is a little concerning here. Non-farm payrolls, the jobs number, it's about half what it was. But again, positive numbers. Inflation rate under control, where last year, 22, we were looking at 8, 9, 10, depending on how you were looking at it, where the inflation rate is moderating, even though it is still quite a bit higher. And then retail sales over month to month, also moving lower, a little concerning there. So, and I think that's been the reason that people have been calling for a recession or a problem in the market, and that may materialize, and some of this economic data may be showing that yet. But as of yet, we're not seeing it in the market, so we don't react to that until we see that pop up. If we look at a forward estimate of earnings here on the S&P 500, analysts are still not marking that down as if there were a recession, saying, "Hey, earnings are going to fall next year." They're certainly looking like they're at least going to stay flat. And higher from where they are right now. So that's also good. If we come here to valuation on the market, it is a bit expensive. If we were to look at, it says fair value 15, which would be this here. A normal might be 20 in a period of lower interest rates, although that's changing now. It does show some overvaluation in the market, but again, not a very good timing tool for looking at the market. It's just important to know where you are, that as we do get more and more expensive here, it could be getting away from a valuation where we want to be. So for the time being, though, we do have rallying markets, and we are invested. In some measures, might be a little cautiously invested because we are concerned about some of the economic issues, and also that the market may be getting ahead of itself. But again, in an uptrend and staying invested, and not a place where we necessarily want to be hiding things. But obviously, everybody's risk measures can be different. If you'd like to hear more about how we're working with clients to do that, I'm going to put up our contact information here. Please feel free to reach out anytime, and we can explain more about how we handle client portfolios. Or if you have any questions, any issues you'd like to see in future discussed in future videos, please do reach out. Hopefully this was helpful and informative, and thanks for watching, and we'll see you at the next update.